Hey, it's Colton Armstrong, and welcome back to Wealth Without Banks Creative Real Estate. Today we are talking about another one of my favorite methods, the seller finance bridge loan. This creative financing strategy allows buyers to secure short term funding directly from the seller, bypassing the need for traditional bank loans. It's a perfect approach for investors who need flexibility and want to close deals quickly. The seller financed bridge loan is structured similarly to a novation agreement, but with a crucial difference. The buyer actually owns the property throughout the entire process. This gives you, as the buyer, more control over the property's future compared to a novation agreement, where disagreements between the buyer and seller can complicate things since the buyer doesn't technically own the property. With this method, you have full control over the rehab and the management of the property. This strategy allows you to purchase the property through seller financing, but negotiate the entry fee or down payment as a balloon payment due in 3 to 12 months. Similar to a novation, this approach helps you get into the deal with less cash up front, so you can use your resources specifically for the rehab. Once the property is improved, you can either refinance or sell it to pay off the balloon payment. It's often easier to negotiate this with the seller, and it's usually more profitable than using hard money or private money loans. In cases where the property is severely distressed, sellers might agree to a delayed balloon payment with 0% interest. This helps the seller avoid paying the mortgage or covering rehab costs while giving you the chance to focus on the property's improvements. By doing so, you significantly increase the property's ARV, which enhances your profitability when you refinance or sell. The seller finance bridge loan offers a faster route to closing deals, allowing you to skip the slow approval process of traditional lenders. This method is particularly useful for fix and flip investors or those needing short-term financing to complete a rehab before moving to long-term funding solutions. To sum it up, the seller-financed bridge loan is another one of my favorite methods because it lets you enter deals with lower cash up front, focus on adding value, and take advantage of delayed payments. It's a flexible and powerful tool for boosting your profitability by raising the property's ARV. In the next chapter, we'll dive into the assumable mortgage, another creative financing tool where you take over the seller's existing mortgage terms. I'll see you in Chapter 12.